In this video, we're going to talk about the top 10 worst investing mistakes beginners will make in 2023. Before starting, please do like this video and subscribe to the channel for future updates. The pandemic, the economic downturn, and the wild stock market ride didn't deter novice investors. 15% of all current U.S. stock market participants began investing in 2020, according to a recent Charles Schwab research of roughly 500 individuals. The financial institution reports that the trend hasn't slowed down as it established 3.2 million new brokerage accounts in the first quarter of 2021, which is more than it did for the entire year of 2020. For new investors, the market is experiencing a lot of activity. The guidelines for wise investing haven't altered just because there are new trends on Wall Street and online. Here are the top 10 worst investing mistakes beginners will make in 2023. Number 10, investing in companies and industries you don't understand. Investing in businesses that operate in many areas is one method to diversify your portfolio. Nonetheless, it is important to remember that it is ideal to do so in fields that you are familiar with, knowing what gives a business a competitive advantage, when they prosper, and when they are likely to keep growing is easier if you are familiar with a certain industry. For instance, investing in the e-commerce and retail sectors might make sense if you are sufficiently knowledgeable about what Amazon, AMZN, or Nike, NKE, do and how macroeconomic factors can affect their stock prices and growth rates. Yet it could be difficult to predict what influences the growth of finance organizations if you are unfamiliar with the financial services sector. Build a diverse portfolio using exchange-traded funds, ETFs, mutual funds, or index funds if you continue to see potential in a particular sector. Number 9, not diversifying. One financial mistake that new investors frequently make is not diversifying their portfolio. It may be tempting to simplify things and buy just a few stocks you believe have a high growth potential, but if either of the stocks fails, it will be a far bigger impact on the entire portfolio than it would be on one that is more diversified. In general, you don't have to acquire an absurd number of various stocks. As a general rule of thumb, 10 to 20 companies across different industries have been shown to be ideal with no more than 5 to 10% allocated on each investment. Number 8, impatience. Making irrational decisions out of impatience, which results in premature selling, is a common mistake. Investors should exercise patience in instances where the market as a whole declines or specific equities have ups and downs in value, because investing is a long-term game that can yield superior profits over the long run. For instance, the stock markets crashed during the COVID-19 pandemic-induced crisis in March 2020, only for them to quickly recover a month later. Many people sold, but those who waited to see how the markets responded profited. Always look for a clear and specific reason why a stock's value decreased before taking any action. These reasons are frequently transient. For instance, if a business experiences problems with its supply chain and runs out of raw materials, it will probably recover after supply shortages. Yet considering selling can be a wise decision if something more significant is present and suggests long-term issues. Number 7, forgetting transaction fees. Inexperienced investors don't frequently consider the transaction fees and taxes associated with trading. Because brokerages charge significant trading commissions for selling your position, switching between investments and buying and selling too frequently might be profit-killing. Since one must expand by an additional 2% before making any gains, these costs should account for more than 2% of the whole deal. To break even, your investment must increase by a full 7% before becoming profitable. Thus, if you place a $100 order and the fee is $7, that equals 7% of the total transaction. Short-term active trading, while potentially profitable, necessitates more time, knowledge, and risk than buy-and-hold tactics. You occasionally need to give investments time to grow. Number 6, failing to regularly evaluate portfolios' performance. Even though it's common knowledge that investors should constantly evaluate the success of their portfolios, novice investors frequently make this error. By doing this, you may improve your investing approach over time by tracking what creates the most value and fine-tuning it. For instance, just because you've chosen a buy-and-hold approach doesn't mean you should let it go and hope for growth. Check your investments' quarterly financial reports, follow the company news, keep an eye on sales growth, and see if any new products or services have been released recently or are planned. For instance, you imagine the performance of your portfolio and find that your individual stock portfolio produces return that are equal to or lower than those of an S&P 500 index fund. It would be wise to invest the funds there or, if necessary, rebalance your portfolio. Number 5, forgetting about taxes. First-time investing can be exciting and joyful, but only until you receive the tax shock. While it's excellent that investing is now more accessible to more individuals, Tricia Rosen, principal of Access Financial Planning, an independent fee-only financial planning firm based in Andover, Massachusetts, notes that many first-time investors are unaware of the tax ramifications of trading. Knowing what taxes you'll owe can help you avoid receiving a hefty surprise bill when you file. Any profit you make through the sale of a security, such as a stock, bond, or the majority of mutual funds after owning it for less than a year is subject to income tax. But if you keep a security for longer than a year, you may be required to pay capital gains taxes on it. These taxes can range from 0% to 15% to 20% depending on your income. There are few exceptions, such as gold, which is taxed at 28% and is regarded as a collectible, even if it's held in an ETF. Number 4, ignoring diversification. Don't neglect to diversify. While part of your portfolio suffers a loss, another section will remain stable thanks to a well-diversified portfolio that includes assets other than equities. For instance, Treasury bonds were steady as stocks fell in March 2020. Thus, investors who held both were probably less nervous when looking at their portfolio. Financial advisor Matt Stevens of Wilmington, North Carolina's Advice Point says it's simple to lose sight of the hazards when the next big thing is all the rage. Comparatively boring, having a diverse portfolio can offer more protection if things go south. Diversify your holdings within each asset class as well. Your equity investments should include small and foreign businesses in addition to those in the S&P 500. Number 3, confusing luck and skill. The founder of Riverbend Financial Management in Myrtle Beach, South Carolina, Jeremy Finger, believes that just because you made money on an investment doesn't necessarily indicate it was a good one. Retail investors consorting on Reddit raised the price of GameStop earlier this year to such an extent that it destroyed hedge funds that were shorting the stock of the video game retailer. However, some investors incurred significant losses when the share price subsequently dropped. Cryptocurrency, another draw for investors, has shown to be unstable. Don't discard your knowledge of investing just because you are successful on one speculative venture. Number 2, making short-term trades. It can be attractive to buy and sell securities on the open market for a short period of time, such as a few days, weeks, or even months. But it can also be extremely risky if you don't do it with a sizable portion of your investment portfolio. The biggest error novice investors make, according to Sally Mullins-Thompson, principal of the financial services company bearing her name in New York City, is trying to time the market. The better course of action, she continues, is to create an investment plan based on goals, time horizon, and risk tolerance, because it is impossible to do it consistently. If your goals or circumstances change, then stay the course and keep the plan. What should my investment time horizon be? Daily variations in the stock market have been demonstrated by academic study to be nearly random. You have a 2 in 3 probability of making money if you wait at least a year. It's around 19 in 20 after 10. Number 1, investing before you're ready. Avoid the error of investing too early if you lack a strong financial base that will enable you to weather any unforeseen storms, such as job loss. According to Hallie Talitsky, a financial advisor at Wilmington, North Carolina-based Cook Capital, this foundation involves developing a budget, paying off any high-interest debt, such as credit cards, and setting up an emergency fund. According to experts, you should have 3 to 6 months' worth of living expenditures, such as rent and utilities, in your emergency fund. Before beginning to invest elsewhere, you should also take advantage of your employer 401k match if one is available, advises Talitsky. When making an investment in a taxable brokerage account, make sure you're making at least the maximum contribution your company will match. Otherwise, you're essentially leaving money on the table. So what'd you think about this video? Let us know in the comment box below. Also, please like this video and subscribe to our channel for future updates.